Well, welcome back to another video at Dennis Banks Forex. Here we go again. Today we are going to look at inducement. Many times you've been taking a trade and price will tap you out or hit your stop loss and then continue in your direction. Well, today this is the explanation. Without wasting further much time, let's get into it. Yes, so what usually happens is that we are having more than one zones, and then we are stuck to choose between which zone to choose. Usually what happens is that this zone is usually taken as inducement. So whereby at some point price will come back, try to retrace, give you a bit of reaction, you're happy, then it comes, it takes you out, then it continues in your direction. So most of the time this usually happens, and many traders don't actually know how to stay in the market. Well, the explanation for this is that at some point this market is trying to rebalance so as to continue higher, but this is a more discount area than this. So, and as price is coming back, it's actually reacting here, hence forming relatively equal lows. So this actually acts as liquidity for the market, and this liquidity is usually taken out, and once price has manipulated a few people, the most probable cause would be continuing higher. So this is one of the major reasons as to why this is actually happening. And then another important factor is explained through use of a Fibonacci retracement. So price moves through premium and the discount. So in an uptrend, as we want to buy, we always want to buy price at a more discount area. So when you actually look at these two zones, one of the zones is more discount than the other. So to make it easier, so let's say that's a price of 95, and then this is a price of 93. So as a trader, let's say you're in a real market, you actually want to invest in New Zealand JPY, you would most probably want to buy at a lower price of 93 compared to the one of 95. So with this tool of the Fibonacci, you can actually see that this pricing is more discount than the other. So those are the scenarios that usually happen in the market. And here, yes, we've gone through, and then we are going to see more chart examples. So let's go through another one that usually happens in this market. Another reason as to why price would actually buy from here is because when you actually look here, the major momentum up to here started at this point. So usually as traders, we have to look out for places with high momentum. So you can actually see that this place here, this demand here, caused a high momentum. So that's why when price actually comes back here, remember the market is moving on emotions of traders. So places whereby high spikes of buy momentum happened in the previous zones, in the previous times, it's more likely for it to come back here. So this is why this also happened. For a bearish, you can actually see price is actually moving. So it takes out this zone, then comes and goes. Yeah. So that is the bearish case scenario, as you can pretty see. Now, there's another scenario that usually happens. Take note. So for this, when the price is coming to take out this high, it will actually first retrace, then continue higher. So for this, what usually happens is that we will have two zones. So this price here has actually taken out this high, but at this case we will have one zone, and we also have one zone here. So actually many traders here will be stuck which zone to actually take. But when you understand which zone actually caused the momentum that broke structure, so when you understand which trade actually took structure, we would actually take our trade from this zone, because it actually took out a structure, or made a break of structure. Yeah, so this is another activity that happened here. So usually here in our examples, there is usually an imbalance, as you can actually see. So there's always an imbalance, and then our demand zone that was responsible for the break. So after knowing all these scenarios, you can now actually navigate market like a pro. So there is also another case scenario that usually happens. So let's say price is moving, makes a break of structure, then also makes a break of structure. Yeah, so usually what happens, price would move, would have its zone here, our another demand zone here, as you can actually see. And usually what really happens is that we would have an imbalance. So as you can see, we are having an imbalance here. Price is actually moving. So actually price moves in phases whereby price has to be efficient. So all these imbalances have to be caught up, have to be filled. So what usually happens is that price will come, give you a reaction, and price will have to make sure that it fills this imbalance. So what usually happens in an uptrend, as you can see, price will come back and take out this zone and then continue moving higher. So these are all case scenarios that happen while we are understanding our inducement. So now in our next now in a couple of minutes, we are going to look at the chart examples to actually understand this inducement. And once you actually understand this, you can use it in any time frame, in any pair. It can actually work anywhere. Yeah, so without wasting time, let's get into it. Yeah, so here we have our New Zealand JPY, as you can actually see. So price took out the high, so we had to wait for price to see how it's moving. So actually we have our price here. It swept the high, swept the low, and yeah, we're actually having it here. And then as you can pretty see, we have our zone here. It's unmitigated, it's a supply, and then you also have another unmitigated supplies here, as you can pretty see. Pretty interesting. So we also have another one here, another supply unmitigated. So most of the time what usually happens as traders, we mark our zones, but we are starstruck. We don't actually know how this price is going to move, because at some point it will come, take you out, react there, yeah, and then this is the time whereby you're entering at this zone. Now it takes you out, then continues down. Or it can actually come, take you out on both of these zones, and then reacts here. So actually understanding how inducement works will actually give you the confirmation you need to take markets like a pro. So when you actually start to think of this, how this market was coming up. So the market first moved down to take out this low. It failed, made a higher high. It came back. So it's pretty important to see that we are having imbalances, and these imbalances have to be fooled. Yeah, so market was coming up, we can see, yes, we are having our imbalances. It's pretty important to mark them. Yeah, so market is actually coming back. You actually just have to understand how this market is moving. So market comes, fails to take out the low. Yeah, now market comes down, fails to take down the low, and then actually what happens is that this supply here, supply zone, actually takes out the low. So this is a strong zone, as you can see, but we always have to take we have to pay attention to detail. So as you can actually see here, we are having equal lows, as you can see. So actually when we are having equal lows, that is a sign of liquidity. So that means that as this price is coming back, yeah, so as you can clearly see, we are having equal highs. So it is very important to actually pay attention to detail and see that yes, we have a supply here, it took out liquidity, but it has equal highs. So this is a form of liquidity that will make this zone to be taken out. So where is the next strong zone that actually participated in taking out the low? Because here price is actually too far, but this is the closest strong zone and it's nearest to liquidity. It is actually taking part in this big displacement. So what we usually do here is that since we are having this liquidity, yes, we would place our trade and protect the low and protect the high, sorry. Yeah, so we'll do a standard 20 pips. Let me just... yeah, so here we'll just do a standard 20 pips and we'll just have to target the low. Yeah, so as you can see here under our risk management, if you haven't looked at our previous videos, you can take a look. So yes, here we can actually risk 1% on our account. So let's say this is 100,000 funded account. We can actually risk $1,000 and be able to earn 7%, which is roughly 7.6K. So the mindset I want you to have as a trader is that you don't need a lot of trades to actually start making money. So yeah, we are having our liquidity. This is our zone that actually participated in taking out this low. Yeah, so all we would have to do is actually play the price and wait. So yeah, we are seeing price is coming. It's kind of reacting on this zone a bit, but we know that we had equal highs here, so it had to be swept. Yeah, so now we wait. So after seeing a bit of momentum here, we would wait for a break of structure. So you wait for any small break of structure, and yes, after getting that break of structure, we'll go break even to protect our money. Yeah, and then we would hold. Yes, so that is the idea here. That is the trade. Yeah, let's look at one more example so that we actually understand how this inducement works. Yes, so we also had another example in GBP USD, which we were able to take. So when you actually analyze here, price had to sweep the high, price also swept the low. So actually this is analogous to one of the most this is similar to most conditions many traders pass through, whereby yes, now they've gotten the direction that we are moving down, but what usually happens is that many traders don't know where to actually take the trade. So some of the traders will want to be more secure in the market, and without knowing, they would put their limits here and they will be able to miss out the trade. But for someone who actually understands how inducement works, is that you will understand that okay, the price moved, retraced, and then actually this supply zone was able to actually take out this low. Yes, so this was the supply that was able to actually take out the low. So when you look at this supply, it was the genesis of this high momentum. So actually when you actually see high momentum, it has taken out the low. And then also we look at the build. So actually when you see as price is coming, price had to create its own liquidity. It made equal highs. So usually what we do, we look at all the confluences. We are seeing an imbalance. So when you actually see, we are having an imbalance that has to be filled. And as price is correcting, you can see that slow movement. So actually when you see equal highs, we always have to take the trade, we always have to take the supply that is nearest. So actually when you look at this, we had to make sure that we take our trade exactly at the supply, and as we know our expectation order flow, we would just have to take the trade up to there. So when you actually see how this trade is moving, we just make sure to hold, because many people psychologically don't know how to hold. So as we said in the previous, once we get a break of structure, we would actually go break even. So price had a swing at our entry, but we held successfully till we hit take profit. So these are the concepts that you actually need to take these trades. Yeah. So thank you for listening, and we meet again in another video.